So last time we are doing consolidation. I'm still further doing consolidation also. So I gave you an assignment. Did you try the assignment that I given? Mulijaribu? I'm not sure if you tried. So today we'll be still be doing consolidation. Now you look at the aspect of subsidiary whenever, and also when we have an associate. And then later you also do the group cash flow. So make sure you don't leave the group before I finish. I'll do even the cash flows today. So now let's continue. We do another illustration. Let's do at May 2017. We go back to the board. We read this question. May 2017, question 4. May 2017, question 4. So the foreign financial statement related to HEMA Limited and its investment company, Shuka Limited and Ajab Limited, for the year ended 30th April 2017. So you're given the income statement for HEMA, Shuka, and Ajab Limited. Then we have, that's the income statement. Then we have the statement of financial position. Let's go to the additional information. Additional information. HEMA Limited acquired the investment in other companies as follows. So we have the company Shuka Limited and Ajab Limited. We have the debt, the shareholding, the cost of purchase, revaluation reserve, and the retained profits. So on a summary form, let's draw the group structure. We draw the group structure. We had HEMA. Then we have Shuka. And we have Ajabu. Then we are told that, number one, Shuka was acquired on 1st May 2014, 80%. So that means this one, it's 80%. So that means Shuka is a subsidiary, but Ajabu, it was 40%. So this is 40%. And then the year ends. You see the year ends on 30th April 2017. The year ends on 30th April 2017. But the date of acquisition, like Shuka, we acquired them on 1st May 2014. So how many months, how many years to the end of, how many years? So from 1st May 2014 to 30th April 2017, that's 3 years. So that means Shuka has been a subsidiary for 3 years. Then for Ajabu, we acquired them 1 year later. That's on 1st May 2015. That means they have been a subsidiary for 2 years. Then another thing we are given there, you are given the cost of purchase, that's the purchase consideration, the revaluation reserve, and the retained earnings. So whenever you're given the revaluation reserves and you are given the pre-acquisition retained earnings, the examiner wants you to compute what we call the goodwill. And we say that, how do we get the goodwill? So let's compute the goodwill, and the goodwill on acquisition. Goodwill on acquisition. Yeah, we said this in an exam, you can ignore it, because it will be hectic for most of you to get it correctly. So we have Shuka Limited. We had Ajabu Limited. So we said the goodwill will take the purchase consideration. And note number one, the cost of purchase there, we are given for Shuka, it's 300. And then for Ajabu it was 200. Yeah, there. Then you're told that HEMA Limited also invested in half of the 10% loan stock in Shuka Limited. Then number two, the fair value of non-controlling interest in Shuka Limited was 75 million. So we're given the fair value of NCI. So that means when you're getting the goodwill for Shuka, you use what we call the full goodwill method. So you have the purchase consideration, then you can add the NCI fair value. That tumeambiwa as a fair value of 75. Then you can less the net assets acquired. And for the net asset acquired, we say that we go to the equity part, go for the equity. And for the equity, here we have the equity elements. So we have the ordinary share capital. This is 200, 200. Also, we have the share premium, revaluation reserve, and retained profit. But we say that for the revaluation reserves and retained profit, you only take pre-acquisition. That means here we have the ordinary share capital. For Shika is 200. The other one is also 200. Then we have the share premium. This one is 50. The other one is 50. But for the revaluation reserve, you take the pre-acquisition revaluation as well as pre-acquisition retained earnings. And you are given that at additional information number 1. Additional information number 1, you are told that you're given the cost of purchase, revaluation reserve, and retained profit. Revaluation reserve and retained profit. So for the revaluation reserve, for Shika, we are given is 20. The other one is 25. And the retained profit, it's 80. The other one is 150. Now you can add the total. So that one you get is 350. Now, for Shika, we are using the full goodwill method because we take the purchase consideration and then we have added the value of the NCI. So the net asset, you don't take the proportion, you take the whole 350. That means the goodwill will be 25. Here for Ajabu, you only acquired them 40%. So that means you add the total, you get 425. For them, there is no NCI. You multiply by the 40%, the proportion acquired, and you get 170. That means the goodwill will be 30. Or before that, let me show you something else. Let's jump to note number, or we come back to that. Or for the full goodwill, you can also use this, this method. You just take this one. This is how you can get the NCI goodwill. You can take the NCI goodwill candle. You take that. You are told the fair value was 75. You take 75. You raise the net asset. The total was 350. You take 350, but NCI. You see, we have acquired 80%. That means the non-controlling interest is 20%. 20%. So that means you take 20% of 350, which is 70. Then you take 75 minus 70, you have 5. Then for the parent, you do this. You take the 300. For the parent, you take 300 minus net asset. And to be honest, the total is 350. 350, but you multiply by, remember the parent, we are controlling them 80%. So, and you get 20. So the total you are getting 25. So it's another method you can use. You take the 300, you don't add this one. You take the total net asset, which is 350, but you multiply by 80%. Then you get the difference. Or still you can use this. You take the purchase consideration, you add the directly, the NCI fair value. Then you minus that one directly. So that means our goodwill is 25 and 30. Let's go. Also, we are told that. Still at number 1. That HEMA Limited also invested in half of the 10% loan stock in Shika. So we had loan stock. The loan stock. So that means the parent gave a loan to the subsidiary. And here we had the loan. Come here. The 10% loan stock, Shuka Limited is 200. So that means they were given a loan of 200. So the HEMA Limited invested in half of the loan stock. So the half of the 200, that means they invested in a loan of 100 million. So that means they're eligible of paying an interest. We have seen it's 10% loan stock. Yeah. We are told it's 10% loan stock. So that means they have been paying an interest of 10% of 100. That means to the income statement, the company will pay 10 as the interest. That means the parent company will receive this 10 as part of income. but the subsidiary, which is the one is paying, they'll show it as part of finance cost or the interest. But for the parent, we'll show this 10 as an income. So that means we need to eliminate. That's what we call the intergroup balances. Then let's go to note number 3. Number three, we are told that during the year ended 30th April 2017, Hema Limited sold goods to Shuka Limited and Ajabu Limited as follows. That's what we call the intergroup sales. Let me take you back. We say that we only consolidate subsidiary. We don't consolidate associate. For the goodwill, you can get it because the goodwill is the parent which is reporting. But when doing the consolidation, we don't consolidate associate. We account for it using the equity method. So here we have the intergroup balance, intergroup sales. We have Shika and Ajabu. So Ajabu is an associate. You only compute for Shika. So the selling price was 100, markup was 25. Then the percentage of good held in stock is 50. So how do we get that? So number 3, we have the intergroup sales, and we have said that you only consider for Shika the subsidiary, which was 100. And we say that how do you adjust for this intergroup sales? The intergroup sale, we say that you eliminate in full from both sales and cost of sales. Then for unrealized profit, because here we have unrealized profit, in this case we are told that they made a markup of 25%. How do you convert markup to margin? We say that if you are given 25, you take 25 out of 125, then you multiply by 100. But then you are told that we have a certain proportion, the percentage of stock, the percentage of good held in stock. We have held 50%. So here we multiply by 50%. So that means we have unrealized profit of 10. How do we account for this 10? How do we account for this 10? We say that for unrealized profit, you add it to cost of sales, you eliminate from the closing stock. That's how you account for intergroup for unrealized profit. But for the intergroup sales, you eliminate in full from both sales and cost of sales. And we have said that we don't consider for Ajabu. Ajabu is just an associate. You don't consolidate associate. Then number 4, on 1st May 2016, Hema Limited sold Shuka Limited an item of plant for 200 million, reporting a 25% profit on cost of the plant. The group charges depreciation at 20% per annum on cost of plant. So remember we said that in case whenever we have the intergroup sale, that's intergroup sale of fixed asset, intergroup sales of fixed asset, we had just 2 items. Number 1, it's all about the profit they made. And then the other one, it's all about what we call the overcharged depreciation. And who sold to who? Yeah, still at number 4. Hema is the parent, sold Shuka Limited an item of plant for 200 million, reporting a profit of 25% on cost. So if we get 25% on cost, so that means it's markup. So how do you convert markup to margin? So you'll take, to get the profit they made, you'll take 25, you divide by 125, the plant was sold for 200. So that means they made a profit of 40. How do we get the overcharge depreciation? For the overcharge depreciation, continue for the question, we are told that the group charges depreciation of 20% per annum on cost. So for overcharge depreciation, you just take 20% times 40 and you'll get 8. How do we account for this profit? This is the same as unrealized profit. So we said that for unrealized profit, you add it to cost of sales, you eliminate from the PPE. For the overcharge depreciation is the vice versa. You add it back to the PPE, but you eliminate from the cost of sales. So the 40, which is unrealized profit on the intergroup sale of fixed asset, you add it to the cost of sale, but you eliminate from the PPE. It's the same as this unrealized profit. It's only that this one you are adding to cost of sale, but you are deducting from the closing stock. Then for the overcharge depreciation, you add it to the PPE, you eliminate from the cost of sales. Go to note number 5. All goodwill of the 2 companies in which Hema Limited has invested are estimated to be impaired by 60% to the year ended 30th April 2017. That's by the end of the year. 20% of the impairment relates to the current year. So how do we get that impairment? Number 4, it's impairment of goodwill. Impairment of goodwill. We are told that. So we had 2 goodwills here. I've not labbed them. It was 25 plus 30. So they had already impaired by 60%. So it's 60% of 25 plus 30. So what do you get there? You found it's 33. But you are told that 20% of this relates to the current year. So if you want to get, so now this is accumulated impairment, but for the year is 20%, of which 20% relates to the current year. So the 20% of that, you get 6.6. Now this 6.6, the impairment for the year, you take it to the income statement. But the accumulated 33, you'll take it to the balance sheet. Then let's get the NCI goodwill. NCI impairment. What do we attribute there? You see, we have said that the NCI goodwill we have computed there, it was supposed to be 5. That means you had an impairment. The impairment is 60% at an impairment of 5. That means the total will be how much? Will be 3. But to the income statement, it's 20%. So that one will be 0.6. Now this one will only affect the NCI. This one is the entire for the group. This one will affect when you're accounting for NCI only. Then let's look at number 6. Number 6, we are told that trade receivable and trade payable include 50 million due from Shika Limited to HEMA. Now that's what we call the intergroup balances. And we said that intergroup balances should be eliminated from both account receivable and account payable. Then we are told that trade receivable and trade payable include 50 million due from Shuka Limited to HEMA Limited and 10 million from Ajabu to HEMA. Now this one from Ajabu to HEMA, that one, remember Ajabu, it's an associate. We don't consolidate the associate, so ignore that. We only now focus on these 50, the one from a parent to the subsidiary. So number 6, it's all about intergroup balances. And you only take the 50. This one you eliminate from both the receivable and the payable. Then number 7, all dividend and interest have been paid by the end of the year. Yeah, all dividend and interest have been paid by the end of the year. So I'll show you how to interpret on that. So when we are through with that, now we can present our financial statements there. Let's present our financial statement. You are required to prepare the consolidated income statement. Let's present the income statement. So the parent was HEMA, but we said that whenever you are writing the heading, you'll not write HEMA Limited. You write it as HEMA Group. And then you show consolidated income statement for the year ended 30th April 2017. So in this case, this is what I'll be doing. For the income statement, I'll take the revenue only for HEMA and Shuka. I'll not consolidate for Ajabu. Ajabu is an associate, and we said we don't consolidate associate. So I'll be taking only for HEMA and Shuka only. So allow me just to copy that. So I'll be having revenue. Then we have cost of sales so that we can have the gross profit. Then I can see we have the investment income. And then with less expenses, we have the distribution expenses. We have admin expenses. we have the finance cost. Then you can write the impairment of goodwill as a separate item. Impairment of goodwill. So that we can get the profit before tax. Then we less the tax expense to get the profit after tax. Then after that, we can add, after we get the profit after tax, now this way you account for the associate. You add associate share of profit after tax. You add it there so that now you can get the total profit. And then you can show attributable to, number one, to the parent, as well as to the NCI. So the revenue for the parent was 1,200 plus for the associate, for the subsidiary, it's 600. You don't add for the associate. The cost of sales, it's 650 plus the 250. Now, let's be here, now we adjust. There is something we said we add to the cost of sale. We say that for the unrealized profit, you add it to the cost of sale. And we had two unrealized profit. One was on the sale of stock. The other one was on sale of intergroup asset. So you add 10, that's the unrealized profit on sale of inventory, plus the sale of non-current asset 40. Then you also say that for the overcharged depreciation of 20%, you added to PPE, you eliminate from the cost of sales. So that means you less 8. This was the overcharged depreciation. Another thing, we say that for the intergroup sales, you eliminate them in full from both revenue and cost of sales. And the intergroup sales was 100 million. Eliminate that. So this one will have 17. The other one will have 842. So that means the gross profit will be 858. Now let's go to the investment income. Here we need to have a point here, investment income. Now for the investment income, let me adjust it here. So from the question, we have 70 for the parent, Shuka Hana, Ajabu, you don't consolidate that. So it's 70. Then remember we are told that all dividends and interest were paid during the year. So you come to the income statement, you confirm if they paid the dividend. You see they paid the dividend. And who do you pay dividend to? You pay the dividend to the parent or to the shareholders. And remember, if Shuka and Ajabu pays dividend, they are paying dividend to the parent, of which the parent will be Hema. So that means of the dividend paid, of this 50 they paid here, and of 30, it's part of investment income received by Hema. Also remember, Hema had also given a loan to Shuka, of which Shuka paid an interest. So it's already included under investment income. So what we do, you eliminate those intergroup. They are called intergroup balances. So you take 70 minus. Here, the dividend paid by Shuka. Shuka paid a dividend of 50. They paid 50, but of this 50, 80% goes to the parent because we are controlling them 80%. Plus, Ajabu is part of the group and they paid a dividend of 30. Of this 30, 40%, because the parent is controlling that associate 40%, 40% ikaenda kwa parent. Plus, the parent itself gave out a loan. We had a loan stock here, of which half of it, which was 100. So the interest receivable by the parent was 10. So that means that interest was already included there, 10. So you'll take 70, you minus this 40, the dividend from this subsidiary. Also, you minus this from the associate, also the interest received, and you'll be having a balance of 8. So now the 8, that's what you include here. That means you are showing interest from the investment income from other sources, not within the group. The intergroup balances, we have eliminated them. We have set them off. Then let's go to expenses, distribution cost. Now for distribution cost, that one is totally direct. You just take 100 for the parent, and for the subsidiary, which is 40, that one is 140. Then we have admin expenses. For admin, you take 130 plus 90. the parent and the subsidiary, and you have 220. Then for the finance cost, it's 40 plus 20 minus the 10. Remember, of the interest paid, of the finance cost of this 20 of Shika, 10 was paid to the parent. So it's already included here. So you eliminate it. So that means you have 50. Then we have impairment of goodwill. Now for the impairment of goodwill, we had the impairment of goodwill, 60%, but of which 20% belongs to this year, to the financial year, which is 6.6. This is what you take to the income statement. So impairment of goodwill will be 6.6. So that means the profit after, before tax will be 449.4. We raise the tax. The tax is the way it is. You just combine the way it is. The income tax expense for the parent is 70. For the other one is 50. So we'll have 120. So that means the profit after tax will be 329.4. Then we add the associate share of profit after tax. The associate, we are controlling them 40%. So it's 40% of the profit after tax. So we come here to the income statement. The profit for the period, it's 70. So you are taking 40% of 70, which will be 28. So that means the total will be 357.4. Yeah, it will be 329. You add the associate profit after tax. So you take the 40% of the profit. This is the profit after tax, which is 28. Now that's the total profit. Now, let's present the balance sheet. We present the balance sheet. We go to another session, balance sheet. How do you show the balance sheet? Kindly remember, when you're writing the heading, the name of the company is HEMA. But you don't write HEMA Limited, it's HEMA Group. HEMA Group. Then we go to consolidated statement of financial position. As at, it was 30th April, 30th April 2017. So in that case, let's start with the assets. We start with the non-current assets. So for the non-current assets, I'm just showing the way they are here, the way they are here. So you take the for PPE, intangible assets. Now for the investments, you combine the two, but you have to eliminate the cost. I'll come to show you what I mean. So to the non-current assets, we have the PPE. For the PPE, you take 1250, that's for the parent. Then you add for the subsidiary, which is 800. Then you add the 8, you minus 40. I'm sure you can't remember I've gotten that. This was the overcharge depreciation. We say that intergroup sale of fixed asset. For the overcharge depreciation, you add back to the PPE. You eliminate from the cost of sales, and this was the profit they had made. This was the unrealized profit. So by that you get 2018. Then you're also given the intangible assets. For the intangible assets, we have 200 plus 70. That one is direct, you have 270. Then for the investments, it was 850 plus 50, but you minus what we call the intergroup investment. Now intergroup investment, this is what I mean. Note number 1, we are given the cost of purchase. We invested Shuka 300, Ajabu 200, you eliminate them. Then, on addition to that, HEMA Limited was invested a half of 10% of own stock in Shuka Limited. Why are we eliminating them? Because they are within the group. So, the investment in Shuka Limited was 300. Investment in Ajabu was 200. Then Shuka was given a loan of 100 million. That means the parent included as part of investments. So, You get the balance, which will be 300. Then you can bring the goodwill now. The goodwill. The goodwill was that it was 25 plus 30. Here, 25 plus 30. Then during the year, or not during the year, they had an accumulated impairment. You see here, 60%. So to the balance sheet, you're eliminating the entire 33. The only 20% for the year, this is what you eliminate from the income statement. But to the balance sheet, you eliminate the accumulated impairment. So in this case, you eliminate 33. So that means you remain with 22. And then here you also include investment in associate. Investment in associate. Remember, I said that we don't consolidate associate, but we account for it using the equity method. Hiyo kwanza achana nayo. We'll come to show you it. That's a thing to ignore in an exam. I'll come to show you how to get that. Let's go to the current assets. The current assets. We are given the inventories there. We have inventory. And for the inventory, you have 200 plus 75. But we said we eliminate the unrealized profit. The unrealized profit here, from intergroup sales, the unrealized profit was 10. You added to the cost of sale, you eliminate from the closing stock, so you minus 10. So we'll have 265. Then you also had trade receivable, trade and other receivables. So we had 300 plus 90, but then you eliminate the intergroup balances. And we say that for the intergroup balances, you only take for the, here what was it? The intergroup balances you had computed earlier, it was 50. So eliminate 50. Intergroup balances you eliminate from the receivable and the payable. So we'll have 340. Then we have cash and cash equivalent. Now for the cash and cash equivalent, it's 150 plus 40, and you'll be having 190. Then let's go to equity and liability. Equity and liabilities. For the equity and liability, we have ordinary share capital. So how much with the ordinary share capital there? Remember, you are not consolidating for the associate. Now for the ordinary share capital, it's 1,000, we have 200, we have 200. You only, in this case, we don't consolidate the AJAB for AJABO. So how much would be the ordinary share capital? Kindly post your answer there. I can only see an answer from one person. So I need to get, I just need the ordinary share capital. I have said that they have given here, you don't consolidate for AJABO, which is a subsidiary. Yeah, I can see now you have been revising. Yeah, from answer I'm getting there, I'm impressed. Yeah, remember I said that for ordinary share capital and share premium, we only take for the parent. So I can see most all of you have written 1,000. That's correct. So that means to the ordinary share capital, you only take for the parent, which is 1,000, as well as the share premium. Also the share premium you take for the parent, which is 300. Then you add, we had revaluation reserve. Revaluation reserve. Then we have retained earnings. And then also you need to add NCI. So kwanza achana nazo. First of all, get the free marks. Come back to them. Let's go to the non-current liabilities. So under the non-current liabilities, we had the 10% loan stock. 10% loan stock. Now the parent, they have a loan of 500. Then the subsidiary has 200. But of this 200, half is from the parent, half of this, which is 100. So that means you only show a loan of 600. We didn't have any non-current assets. Then we go to the current assets. So to the current assets, we have the trade and other payable. So you have trade payable. So you take 250, you add another 250, but you eliminate the intergroup balances. The intergroup balances, it's 50. Tukatoa kwa receivable, tukatoa kwa payable. So, and you get 450. Then you also had current tax. And the current tax is just 20 plus 20. You'll get 40. So now when presenting this to the balance sheet, I have not computed the valuation, retained earning, NCI. So that means you can get, those are the free marks, 1, 2, 3. Goodwill achana nayo. That one high chances you not get it correctly. So you have 1, 2, 3, 4, 5, 6, 7, 8. Those are 2 marks. 8. Then we have 9, 10, 11. And the examiner is giving you just 10 marks. That means you have 10 out of 10. And in this case, you have not stressed yourself by computing. I have not counted this for goodwill and for the 3. Now let's go back to class. One thing we never computed is investment in associate. How do you use that? So now for the student who is working smart, just get up to that point. Now for the rest, I want to show you how to get them. So how do you get that? So we started the first one. We had a first gap of investment in associate. Investment in associate. We say that investment in associate, we account for it using the equity method. And this is how you account for it. You take the purchase consideration. The purchase consideration. We had acquired Ajabu for 200. Was it 2? Yeah, it was 200. That was the purchase consideration. Yeah, if you look at that. Then you add the post-acquisition changes in net assets. The post-acquisition changes in net asset. So in this our case, what I've changed is 2 items, the retained earnings and the revaluation. So remember, you're controlling them 40%. Just take 40% off. Let's start with the retained earnings. Retained earnings. As you can see here, you're looking at investment in associate. Their retained profit is 200. Yeah, the retained profit is 200. But at the date, oh, this is 200. And so the retained earning is 200 minus at the date of acquisition. Here we have the retained profit. At the date of acquisition for Ajabu, it was 150. So at the date of acquisition was 150. As per now is 200. That means it has changed from the date of acquisition. The post-acquisition changes. It has changed with 50. So it's 50 times 40%, and it will get 20. We go to the revaluation reserve. From the revaluation from the trial balance, so you can see here, we have revaluation reserve. It was 50. We have 50, I mean. We have 50 as per now. So it's 50 minus, at the date of acquisition, we have the revaluation reserve here. It was 25. That means it has changed. It has changed by 25. So you take 40% of 25. So in that case, you'll get 10. So that means to this investment in associate, you'll take 230. So ukikuja hapa, where we had a gap, investment in associate, now you can write 230. Tukuja hapa chini kwa revaluation reserve. How do we get for revaluation reserve? Now for the revaluation reserve, you take for the parent, and for the parent, the revaluation reserve is 200. Then you add the post-acquisition changes also. You take the post-acquisition changes, or you take only the parent proportion. This is what I mean. This is what I mean. At the date of acquisition, or we are looking now at this, tuangalie tuanze na shuka. The revaluation reserve is 50. The revaluation reserve is 50. So you'll take 50 minus, at the date of acquisition was 20. You take 80%. That's for the subsidiary. Plus, we have seen for the associate. For the associate, we have seen that it's 50. Well, we are looking at revaluation. It's 50 minus the 25. You take 40%. That's what we are doing. We are taking the post-acquisition changes. You take for the parent revaluation reserve, then you add the post-acquisition of the investee. So this is the subsidiary, which is Shika. We acquired them when the revaluation reserve was 20. As per now, it's 50. That means has changed by 30. So that 30, you take the 80%. You go to the associate, you do the same. It was 25, as per now it's 50. It has changed by 25. You take the 40%. So, and by that, you get the revaluation will be 234. So, and the revaluation reserve, it will be 234. So now let's look at something else. You can look at retained earnings. Let's look at retained earnings. Now, retained earnings, you take the parent retained earnings, then you add investee share of post acquisition. Investee share. So in this case, investee we have two. We have Shika and we have Ajabu. Shika, we have a claim of 80%. This one we have 40%. And we are looking at investee share of post acquisition. So for this post acquisition, let's start with the parent. The parent retained earnings. The retained profit is 710. You can see it's 710. So you'll take 710 minus, we adjust. We adjust. Remember the parent sold an item of plant to Shika. Waka make profit yangapi? Yeah, 40. This was the unrealized profit. It was made by the parent because the parent was the one which sold to the associate. And then also the parent sold good to also subsidiary and made an unrealized profit of 10. This was from the sale of non-current assets. This was from the sale of inventory. So we'll get the adjusted parent profit will be 660. Then for Shika, the retained earning is 375. And the other one is 200 as per the trial balance. Minus, we're only looking at the post-acquisition. At the date of acquisition, for Shika, the retained earnings was 80 and the other one was 150. That was at the date of acquisition. Yeah, this is what I'm doing. At the date of acquisition, we had the retained profits. For Shika was 80, the other one was 150. So what I've done, I've taken 375, which is the retained earning as per the balance sheet. At the date of acquisition, it was 80. So now we are looking at investee share of post-acquisition changes. But for Shika, remember the parent sold an item to Shika and made a profit of 40. That means Shika overcharged the depreciation. There was an overcharged depreciation of 8. You add it back. Yeah, that's why I'm telling you in an exam kind of achana hii. So for Shika, 80% of that you'll get is 242.4, and this one you'll get 20. So that means the retained earning you'll have 922.4. So unakuja hapa, retained earning 922.4. I'm sure now we are okay. So now we are okay. Let's get for NCI. How do we get for the NCI? How do we get NCI? NCI, remember, is just Shika. You just take its equity items or the net assets. The net assets. So in this case, the net assets, utakuja hapa, this is Shika. You come to the equity. The ordinary share capital is 200. Share premium is 50. Revaluation is 50. Retained profit is 375. You just add the way they are. So you will take 20% of the ordinary share capital is 200 plus 50 plus another 50 plus 375. That's retained earnings. But for this retained earnings, Shika Limited, they overcharge the depreciation. You add back the overcharge depreciation to adjust for this retained earnings, and you'll get 136.6. And then we add, remember we had NCI goodwill. Tulikuwa tumepata it was 5. Let me show you where it was. Yeah, here it is. Remember we had NCI goodwill, which was 5. So you take 5 minus the impairment. The goodwill was impaired. We had NCI impairment, which is 60% times 5. Tukapata it was 3. So you minus the 3. Kwa hivyo itabakia 2. So you'll get it 138.6. So that means the NCI here will show 138.6. Now I'm sure you are okay in that. So I can see someone is asking, when calculating the investment in associate, are we not lessing the goodwill impaired? No, the goodwill was impaired from the side of the parent, not on the side of associate. Remember, the goodwill will be determined by the parent, not by the associate. That's why I'm not deducting from the investment in associate. Now, if I take you back to the income statement, the revenue in most cases and the cost of sale, they carry 2 marks each. So kindly make sure you know how to adjust them. So you can get 4 marks, then you can get 5, 6, 7, 8, 9, 10. And sometimes the heading can give you a mark. So let me give you an assignment. Write it somewhere. I want you to go and try November 2015. November 2015, question 5. Actually, now you can be able to try all the questions for groups. Each sitting, this is a question that never misses. So kindly go through all the and try to do to go through them. Try to adjust. The most important thing is how to adjust and how to post. When you are writing, the heading should be group. As we look for to something else, I want us to look at something else. Look at something else. So I think I'm through with groups. I want us to go to another subtopic, or we can call it a topic, but it requires the concept of groups. It requires the concept of the group. And now we'll be looking at what we call the group cash flows. I want us to look at group cash flows. And the same as with what you learned at section 1, where cash flow. A cash flow is just a statement showing the inflows and the outflows. And then the format does not change. What you run in section 1, what you are running here, and what you run in section 6 will still be the same. So the statement of cash flow is regulated by IS number 7. And we have 2 methods you can use to present. We have the indirect method and we have the direct method. But the most popular method is the indirect method. There you have the format. Then you get that the cash flow statement is usually classified into 3 items. We had the operating activities. Now the operating activities, they are day-to-day activities. Then we have investing activities. For the investing activities, cash flows. For the investment activities, cash flows. So it deals with how the company acquires and disposes the assets. And then we have the financing activities. Now for the financing activities, it shows how the company finances the business. How can you finance the business? Number 1, you can finance the business through the use of ordinary share, through the issue of debenture, through borrowing of loans, preference shares. So that one entails the financing activities cash flow. And then we have said that I have the operating, investing, and financing. So, and this is the format. This is the format. So kindly, if you want to get cash flow clearly, you just need to cram or you get that format. So we start with the operating activities cash flow. You always start with the profit before tax. Then you adjust for non-operating expense items. So like depreciation, you add back. You're adding back because it's a non-cash item. Amortization, you add back. Loss on disposal, you add back. Finance cost, you add back. Why are you adding back finance cost? Because finance cost is not part of operating. It's part of financing. Then gain on disposal, you eliminate. Because it's not part of operating, it should be part of investing. Then you had associate profit, also investment income and dividend income. You deduct them. You're deducting them from operating because investment income and dividend, they are not part of operating. They are part of investing. You less them there, unazileta hapa chini. Then you bring the changes in working capital. The changes in working capital. So in that case, you look at 3 items: the inventory, receivables, and payable. In short, you are looking at the current assets and current liability, except the cash. So you look at the increase or decrease in inventory, also the receivable and the payable. And then you get the gross operating cash flows. From there, you deduct the amount of tax paid so that you can get the net operating cash flows. When you go to the investing activities cash flows, you start with the cash proceed from disposal. In case you dispose an item at cash, the amount you got, you bring it here. Then you bring the dividend or the interest or the investment income received, you add it. Disposal of subsidiary, ignore this. That one you tackle it as section 6. Also the other one, acquisition of subsidiary, here on section 6. Then we have purchase of non-current assets. In case you acquire a non-current asset, that one is an outflow. You are incurring cash, so you raise. So another thing you need to note, for when you're preparing the statement of cash flow, it's good to differentiate between an inflow and an outflow. If you write an inflow as an outflow, you'll get a wrong answer. The figure can be correct, but the sign inflow and outflow changes everything. Then we go to the third part, the financing activities cash flow. For the financing activities cash flow, you bring cash received from the issue of share, cash from the issue of debenture, the loan you borrowed. In case you pay the loan paid, that one is an outflow, you minus that. Then we have the dividend or interest paid, you deduct it there. Also, in case we have the lease rental paid, you minus. Then you get the net financing cash flows. Then from there, you can get cash and cash equivalent. Cash and cash equivalent, you take the net for the operating, the net for the investing, and the net for the financing. Then you add cash balance brought down for you to get cash and cash equivalent balance carried down. And they should be in agreement. In short, that means it should balance. Good. So let's do an illustration. May 2014. May 2014, question 4. May 2014, question 4. So the consolidated income statement for Wongo's Limited for the year ended 30th September 2013, together with the comparative consolidated statement of financial position as at 30th September 2013 and 2012 are shown below. So we have the income statement there. Then we have the statement of financial position. Now, for the statement, when preparing the cash flow, for the balance sheet, it will be given the comparative. That means it will be given for 2 years. This is what I mean. For the balance sheet, you are given for 2012 and you have for 2013. For example, for PPE, 2012, the value was 3660, but as 2013 was 3780. You can see there is a change. So now that change, you have to explain it through the statement of cash flow. Why did the asset increase from 3660 to 3780? Is it an inflow? Is it an outflow? That's why the balance sheet will be given 2 years. So that means for all the items under the statement of financial position, you have to open a T account to determine whether it's a gain, an increase, or a decrease. So you have to open the T account for all the items here, except For the inventory and receivable and account payables, and for the account payables, they'll give you the working capital changes. Then the cash, that's under current assets, and the bank overdrafts will give you the cash and cash equivalent. That means all the other items not touched here, you have to open a T account. You have to explain them, except the current assets and the bank overdraft and the trade payables or the account payables. So let's go to additional information. The cost of sales included depreciation on PPE amounting to 640 million and loss on sale of plant of 100 million. So number one, imeguza vitu mbili. Imeguza disposal and the PPE. So that means we open the two accounts there. We're doing cash flow. So allow me to open the two accounts. One is the PPE account, and this one is a disposal account. Now, PPE is an asset. That means you'll be having the balance brought down on that side, and here you'll be having the balance carried down. So from the trial balance, we have here the PPE. Remember, 2012 is our opening balance. The closing is 2013. So the balance brought down will be that 660. The balance carried down will be that 780. So the balance brought down, we have that 660, and the balance carried down will be that 780. For the disposal, here we usually bring the PPE disposed. Then here we bring the disposal proceeds. Disposal proceeds. If the disposal proceeds is more than the PPE, that means you sold that item at a gain. But in case the value, the net book value of PPE is greater than the proceed, that means you disposed at a loss. Let me take you back to note number one. Number one, you are told that the cost of sales include depreciation and PPE of PPE amounting to 640. So that means here, remember when an asset depreciate, unatoa, So here we have depreciation, which is 640. That one you eliminate. And loss on sale of plant of 100. So we had a disposal loss here of 100. It's already 100. Let's go to note number two. Note number two. Number two, you are told that intangible assets are stated at net book value and comprises. So you have goodwill and we have others. So let me open the account for two, or it's not a must, I have to open for two. Let me start with goodwill. You need to explain this. It's not a must, you have to open an account. Like you see for goodwill, you are told that the opening balance was 400. At the end is 360. What has happened? There is a decrease from 400 to 360. What do you think can make your goodwill to reduce? Now that's what we call impairment. So goodwill, you take the 400 minus 360, there is 4. That's what we call the impairment of goodwill. Then we have other intangible assets. Also given here, the other intangible assets. Then other intangible assets acquired during the year ended 30th September 2013 amounted to 100 million. The cost of intangible assets is included in the above analysis. Now this is what I mean. We started with 200. That's opening balance. Then remember, other intangible assets acquired during the year amounted to 1,000. So it's 200, that's the opening. We acquired another one for 1,000. That means we are having 1,200. But you are told at the end, we only have 940. So what is that? So we have other intangible assets. The balance brought down was 200. Then during the year, we acquired 1,000. So that means we already have 1,200. But you are told at the end, the other intangible assets is just 940. So by the end, you are told it's 940. That means there is a reduction. There is a reduction by how much? There is a reduction by 260. Also, that one is also what we call the impairment of intangible assets. From 200, you can increase. We acquired them. We acquired another one for 1,000, so it was supposed to be 1,200. But at the end, it's just 940. So that means there was a reduction by 260. That's the impairment of intangible assets. Let's go to note number 3. During the year ended 30th September 2013, the holding company acquired new plant, which cost 500 million. So when you acquire an asset, that means that your asset increases, so you debit the PPE. The company also revalued its building by 400 million. So how will that affect our PPE? There was an acquisition at 500. Also, we revalued the asset. Remember, revaluation increases the value. We revalued the asset by 400. Then, number 4. On 1st October 2012, the holding company made a bonus issue of 1 share for every 10 shares held. So that's bonus. The issue was financed from the revaluation reserve. So how do we account for that bonus? Let's account for that bonus. We have a bonus issue here. And the issue was 1 share for every 10 held. What about, we come back here. We had the ordinary share capital. At the beginning, it's 1,000, but the par value is 10. So how many shares do we have? So it's 1,000 divided by 10. That means we started with 100 shares. And we are told that for every 10, you are given a bonus of 1. What about 100? So to me, how do you get 100? I've taken 1,000 divided by the par value. So we had 100 share. For every 10, you get 1 bonus. What about 100? That means you got a bonus of 10. It's 100 times 1 divided by 10 is 10. Then each at 10. That means we made, so these are the shillings, the 10 million shares, each at 10. That means we issued a bonus worth 100. How did that affect? How did that affect? So now this one will affect our ordinary share capital. And our ordinary share capital will be like this. Let's adjust for ordinary share capital. So ordinary share capital tulianza na 1,000. Then we made a bonus issue, 100. So that means we are supposed to be having 11. But you are told at the end, you see, has increased to 1,500. So what's the change? So the ordinary share capital, this is what I've done. We started with 1,000. Then we made a bonus issue. We given shares for free, worth 100. So that means our share capital increases to 1,100. But you are told at the end, at 2013, the share capital is 1,500. That means there is an increase from 1,100 to 1,500. There is an increase by 400. What can make your share to increase by 400? So that's the issue of shares. Yeah, tukapata pesa. So that's cash. Good. Then we go to note number 5. Number 5, we are told that the detailed analysis of the retained profits as at 30th September 2013 and 2012 were as follows. So you have the balance brought forward, profit for the year, transfer from revaluation reserves, dividend declared and paid, and the balance carried down. So that means when you'll be preparing the analysis of the item of the balance sheet, the retained earning, you already given the analysis. The balance brought down, we added the profit for the year, then we transferred from revaluation reserves, and then the dividend declared. Then you have the balance carried down. So required, the statement of cash flow for the year ended 30th September 2013 in conformity with IAS 7, statement of cash flow, 20 marks. Now what you usually do, after you are through with all your workings, you need to adjust all the items under the balance sheet. We said that we have to adjust everything. So in that's our case. Let's now try to review that. Or first of all, let's close what we have already opened. We had already opened for PPE. Now the PPE, let's close that account. We open that account. We close. So I think this side is more. is that 660 plus 900, you get 4560. 4560. So that means you have a balancing figure hapa. Imepungua na ngapi? 140. What do you think is this 140? What can make your PPE to decrease? Kindly post your answer there. What do you think is this 140? What can make your PPE to decrease? So post your answer there. I can see you are thinking. Only to have answered. Can see from Charles. Yeah, continue typing your answers there. Yeah, the answer you are giving there, they are correct. Others are saying depreciation, other disposal. Yeah, an asset can reduce due to two things. Number one, it's either the depreciation, of which you already have the depreciation. So this means 140 cannot be depreciation because we already have depreciation. So that means it was a disposal. It was a disposal. And that's why in a disposal account, we are not given the PPE. So that means the asset disposed, this 140 utaleta hapa, the PPE disposed was worth 140. But we are told that we disposed at a loss of 100. So let's cross this 140, 140. So that means the disposal proceed itakuwa ngapi? The balancing figure, which is 40. Now this is what I mean. The asset was worth 140, but we only sold it for 40. So that means we suffered a loss of 100. So this kuna mali tutapeleka. Then we go back, we have said that we have to adjust all the item and the statement of financial position. Now PP we have adjusted. Intangible asset we adjust because we are told that intangible asset comprised of goodwill and other intangible assets. We had adjusted that one. Investment in associate company, not yet. Let's adjust that. Investment in associate. So for the investment in associate, this is how you argue. The balance brought down was 160. At the end is 190. Then investment in associate company is always affected by the income statement. You can see here we have group share of associate profit after tax. So this is what it means. The balance brought down was 160. Then during the year they made a profit. You see there is a share of profit of 40. So you take 160, you add 140. So that means for the investment in associate, we started with 160. Then to the income statement, they made a profit of 40. Kwa hivyo inakuja 200. But by the end, you are told the balance it's 190. So from 200 to 190, that means there is a reduction of 10. Now this is what we call dividend received from associate. Those are the dividend received from associate. So now let's look at, so we are through with the non-current assets, the PP, intangible asset, investment in associate. Current asset tulisema hatuguzangi. Inventory and receivable, their working capital changes. Cash is part of cash and cash equivalent. Ordinary share capital, we have already adjusted it. Ya tushafanya, ndio hii, the ordinary share capital. Then we had share premium. Share premium, not yet. Now the share premium, we started by 200, size in 700. So there is an increase by 500. What is that? Now that's what we call issue of share at a premium. So we still got cash. So under the share premium, we started by 200. By the end of the year, it was 700. So that means the share premium increased by 500. So that's what we call, it is still issue of share at a premium. So that means during the year we issued the share, worth, you see this one from the share premium and then the ordinary share capital, 400. Now this 400 is at par value and this one is at a premium. But both they are still cash received. What else do we have there? So that's the ordinary share capital, share premium. Then we have revaluation reserve. Now revaluation reserve, that one should balance itself. Revaluation, you don't take it anywhere. So this is what I mean. For revaluation reserve, Tulianza na ngapi? You see it's 0. Tulianza na 0. But during the year, there was a revaluation from the PP. Remember you revalued an asset 400, eh? Kwa hivyo revaluation ikaongezeka na 400. Then minus tukuje hapa. There was transfer. Let's go to note number 5. Note number 5. You see there is transfer from revaluation reserve. From revaluation we transferred 20. Then note number 4. On 1st October 2012, the holding company made a bonus issue of 1 share for every 10 shares held. Then you are told that the issue was financed from the revaluation reserve. So we had already issued bonus. This 100 came from revaluation reserve minus 100. And then there was transfer from reserves 20. So that means inabakia 280. Na ndio hii tumepewa hapa. That one is okay. Yeah, revaluation is 280. So that one is okay. 280. Then retained profit, that one don't have to adjust. Retained profit is already, it was already adjusted. You're already given the breakdown, note number 5. The detailed analysis of the retained profit, already given that. So that one you don't have to adjust. Then we have non-controlling interest, NCI. How do we get the NCI? So let's adjust for NCI. This is how we adjust for NCI. It's very easy. The non-controlling interest, I'm hoping we are there. Tulianza na 200, but by the end it's 270. Associate and NCI are affected by the income statement. This is what I mean. If you come here to the, you see here, profit for the period. There is attributable to the parent company and attributable to non-controlling interest. So the balance brought down was 200. Then during the year, they made a profit of 80. So it will be 200, you add 80. So the NCI will be, tulianza na 200, that was the balance brought down. Profit attributable to the NCI was 80. So that means should be 280. But you are told that the NCI at the end, I'm here, the NCI at the end is 270. So what has happened? At the end is 270. It has moved from 280 to 270. We have 10. Now this is what we call dividend paid to NCI. We pay to NCI, we receive dividend from associate. Yeah, you see like here, we have the group share of associate profit after tax. That one we received, but this one is attributable to, so that one is an outflow. So that was NCI. Tumemalizana na hiyo. Tuende kwa non-current liability. 10% debenture. Debenture, we started with by 200. Size is 600. So what has happened? There is an increase from 200 to 600. There is an increase by 400. That's what we call issue of debentures. Issue of debentures. Imeanza 200. As per now, you are given is 600. So that means we should debenture worth 400. So hiyo ni pesa, it's a cash inflow. Then we have the bank loan. Bank loan. We started by 600, as per now it's 520. So what has happened there? What has happened there? So it's from 600 to 520. So that's what we call the loan repayment. It's a reduction. Loan repayment. Tumeanza na 600, saizi ni 520. So that means it has gone down by 80. So now that's what we call loan repaid or loan repayment. Good. Then I can see Fed is asking, the share we issued 400, not this 400, kindly, the ordinary share capital, the one we have deducted from the revaluation. It's this one, the bonus issue. This is what was financed from the revaluation reserve. not this. This was cash received. This was what was financed from Revolution Reserve. So that's why I've used 100, not the 400 for the issue of share. So that was bank loan. Now let's go to deferred tax. Deferred tax. Now for deferred tax, we have deferred tax here and we have the current tax. Both are tax. You can just open an account. Let me show you how to combine the two. We combine the two. We open the tax account. The two, they are liability. So you start with the balance brought down, balance carried down. We have both the deferred and we have the current. Deferred and the current. Like here for the deferred tax, the balance brought down is 280, the carried down is 620. So it's 280, that's the balance brought down for deferred tax, the carried down is 620. Then you go to the current tax, there's the current tax. The current tax, the balance brought down is 320, 260. So here we have 320, 260. Then when where we have the balance brought down, you write to the income statement. Remember, the tax is also affected by the income statement. Now, during the year, from the income statement, you can see we had income tax expense, So during the year, we are charged tax of 540. That's what we are supposed to pay, an amount of 540. Now, let's cross that. We need to know the actual amount of tax paid. So it's 280 plus 320 plus 540. So on that one, what do you get? So it's 280 plus 320 plus 540, you'll be getting 1140. But you are told at the end of the year, imebakia 620 na 260. So you minus 620 minus 260. So imebakia 260. Now what do you think is this 260? That means our tax has gone down by 260. Now that's what we call the tax paid during the year. So now this is what you take the statement of cash flow, not the 540. The 540 was what was charged, but in cash flow, you're dealing with actual cash inflow, actual cash outflow. So the tax paid, the reduction. So that means during the year, we paid a tax worth 260 million. So still continue there. Bank overdraft tulisema tukuzangi hiyo and account payable. We have accrued loan interest. Let's look at interest. Interest, we need to get the interest paid. Now for the accrued interest, this is how you argue. Tulianza na 10, but the end is 30. But interest will be affected by the income statement. We have the interest for the year, which is known as the finance cost. You see, we have the finance cost, which was 60. So this is what we mean. The balance brought down for the current for the interest paid is 10. That's what we started with. Tukaanza na 10. Plus during the year, the interest for the year, which is finance cost, part of finance cost, it's 60. During the year, tukachajua interest here 60. So that means it's supposed to be 70. But at the end of the year, the accrued loan interest, tumebakisha only 30. The balance at the end is 30. So it was 10. Then we are charged 60 to the income statement. Now we have 70. But the balance remaining is just 30. So there is a reduction by 40. Now that's what we call the interest paid. That's the actual interest paid. That means kwa finance cost tutatoa the 40. And then we are through with that. Now we have the dividend payable. Let's account for that, dividend payable. Now dividend payable, the balance was 400. By the end is 560. But remember, we pay dividend from retained earnings. Note number 5, we are given the detailed analysis of retained profits. We look at the dividend we are supposed to pay for 2013. This is our year. We had dividend declared and paid. So we declared 800, but 2013 we had already paid 6. So we had dividend declared and paid. For 2013 is 8. Now this is what you'll do. You want to know the amount of dividend paid. The dividend paid. So we are told here the dividend payable, the balance is 400. That was our balance, 400. Then during the year, we declared a dividend. Note number 5 here. the dividend declared during the year, we declared dividend was 800. By last year tuko tumelipa 400, during the year tukadeclare zingine 800, so that means the shareholder wanagoja dividend worth 1200. But you are told by the end of 2013 the dividend payable by the end is just 560. Kwa hivyo imepungua 560. Imepungua na ngapi? 1200 minus 560, you'll get 640. Now this is what we call the dividend paid. The dividend paid. Then the last item was current tax. Current tax already we have adjusted for it when you're getting the tax expense. Good. So now we can present the cash flows. And that was just the workings. So now let's prepare the cash flows. So the name of company was Uongozi Group. Consolidated statement of cash flows for the year ended 30th September 2013. Our shillings are in millions. So now what I'm doing here, I'm just following the format. In this case, we say the format is everything. So allow me just to write the format. So if you want to pass cash flow, just you need to get that format or you cram it. So we say that we start with operating activities cash flows. Then we bring profit before tax, that's a free marks. Then we go to adjustments. We say that kwa adjustment tunaleta vitu kama depreciation, impairment. For impairment we have two. We had for goodwill and we had for other intangible assets. Then we also had finance cost. You add it back. Also we had loss on disposal. Then you can bring the working capital changes. For the working capital changes, we look at 3 items: the inventory, the receivables, and the payables. Then you can get the gross operating cash flows. Then you can less the amount of tax paid, and then you can less the interest paid. Now for the interest, you can either deduct it here or you deduct it at a part of our financing cost. Unaweza itoa hapa or utoe kwa finance cost. So now what I've done there, I've just copied this format. Nothing I've changed. Profit before tax adjustment, nikaongeza depreciation, amortization impairment, loss on disposal, finance cost. We didn't have gain on disposal. Then I bring the changes in working capital, the changes in inventory, receivables, and payable. Then you get the gross operating cash flow. Then you less the tax paid. That's what I have done there. So that was the first part. So then you will get net operating cash flows. Then you go to the other part. The other part was you're supposed to bring what we call the investing activities cash flows. Investing activities cash flows. We say that under investing, we are dealing with how do we invest. So, and our format, we're supposed to bring from our format is the proceeds from or proceeds on disposal. Remember, we sold an item at a loss. So we bring the proceeds, what you got from that. Then we had dividend received. We invest, we get dividend. Dividend received. And in this case, we received dividend from associate. Then we acquired assets. There was acquisition of assets. Number one, we acquired the PPE, and then there was also acquisition of other intangible assets. Other intangible assets. Now you can get the net investing cash flows. Then you go to the other part C. It's financing activities cash flows. Financing activities cash flows. Now for the financing activities cash flows, we have the issue of shares. Kuna ile to issue from the ordinary share capital and from the share premium. Then there was issue of debentures, tukapata pesa. Then there was loan repayment, tukalipa deni, that's an outflow. Then we paid dividend. Number one, we paid to the parent or to the ordinary shareholders. And then we paid to the NCI. Now you can get the net financing cash flows. Net financing cash flows. Now from there, you can get cash and cash equivalents. You take the summation of A plus B plus C, and then you add the cash balance brought down for you to get the cash balance carried down. So I've just copied the format. So for cash flow format is everything. So now let's start with the profit before tax. The profit before tax, here is it. The profit before tax, it was 1740. So bring 1740. Adjustment, you add depreciation, 3 marks. The cost of sale include depreciation of PP amounting to 640. Depreciation, you add 640. And loss on sale of plant of 100. Also up at, remember you say that you also bring the loss on disposal, which is 100. You wanna add back. So those are the 3 marks without computing. Then impairment of goodwill. Here we had already computed it. Goodwill. The impairment was 40. So unaiongeza. Then impairment of other intangible assets. Other intangible assets, there was an impairment of 260. So you add it back there. Finance cost, unaleta hii. This one, finance cost. They had already deducted 60, the finance cost. So now that's what you deduct from here. Or I mean, you add it back, 60. Then let's go to the working capital changes. Inventory. Let's start with the inventory. Now this is how you argue for inventory. Let's be here for inventory. Inventory, tulianza na 1880. By the end is 2840. So what has happened? From 1880 to 2840, there is increase in inventory. So that increase ni ngapi? So is 2840 minus 1880. It's an increase. So that means the inventory increased by an amount of 42. Sorry, not 42. That is 960. Is it an inflow or outflow? Is it an inflow or outflow? If the inventory may increase, that means tulinunua. So that means it's a cash outflow. Inventory ikireduce, that means tumeuza. That one becomes inflow. But inventory increase, that means tumenunua. So in our case, we have seen that the inventory has increased because it's from 1880, that's 2012, to 2840. That means there was an increase by 960. An increase in inventory, that means we acquired more. Let's go to account receivable. Tulianza na 1360. By the end is 1980. So what has happened? there is an increase from 1360 to 1980. 1980 minus 360, 1360. So there is an increase by 620. So what can make your receivable increase? Debtors wako wana increase because they are not paying you. Watu wako na madeni, so that's a cash outflow. In case debtor reduces, that means the debtors wanakulipa, unapunguza madeni. So in this case, it has gone up. So that means the debtors are not paying you, so that's a cash outflow. Then we have the payables. A payable is liability. So the account payable, here it is. We started with 1460. By the end, it's 1750. An increase in account payable from 1460 to 1750. So the increase na ngapi? So it's 1750 minus 1460. It's still an increase. And it's an increase by how much? That was an increase by 290. Is it an inflow or outflow? What can make your account payable increase? Payable may increase. That means, remember payable, you are supposed to pay them. In this case, they have increased. That means you have not been paying them. So you are holding cash. So that means it's an inflow. If payable increases, that one becomes an inflow. That means you are not paying your suppliers. So you already have the cash. Then from there, you can get the gross operating cash flows. You'll get 1550. You take that, you add that, you minus that, you add that. Then you raise the tax paid. Now for the tax paid, you had already opened an account here. Yeah, the tax paid during the year was 260. So for tax paid, it was 260. That's an outflow. And also the interest paid. Interest paid, tumetafuta hapa. The interest paid, we have seen it was 40. That's the interest paid. So utwe na hiyo 40. So that means the net operating cash flows will be 1250. You can call it A. Let's go to the investing activity cash flow. You bring the proceeds on disposal. Now proceed on disposal. Ndio hii. On the disposal account, we had the proceeds. We got the proceeds of 40. So you add that 40 there. Dividend received from associate. Dividend received from associate. Here we had the associate. Investment in associate, we had dividend of 10. That was a dividend received. So unaongeza, that's a cash inflow. Acquisition of assets, PPE. Tuangalie hapa. We are told that during the year, there was an acquisition, 500. So that means if you acquired for 500, this is not an inflow, it's an outflow. We are acquiring the assets, so we are incurring cash. Also, other intangible assets. Other intangible assets. You've already been given that. Note number 2, hapo chini. Other intangible assets acquired during the year ended 30th September amounted to 1,000 million. So, other intangible assets, it's 1,000. You unatoa. So now you can get the net financing cash flow, investing cash flow, which is 1450, which is a negative. Because if you take 15 now and 50, that one you are getting 1450, a negative. Let's go to financing activities cash flows. Issue of share. From the issue of share, we had 400, and from the share premium was 500. Ndio hiyo hapo, hata sijafuta. From the ordinary share capital, there was issue of share of 400. That's the issue of share. And then from the share premium, it increased by 500. So unaongeza hapo. Then we have issue of debentures. Here we have issue of debenture. From the workings, we had the issue of debentures here, which was 400. So we can increase na 400. Loan repayment, tukalipa loan. We had a loan repayment here. And the loan repayment was moved from 620 to 520. So we paid 80. So kama tulilipa, that's a cash outflow. Dividend paid to ordinary shareholders. Remember, you already have the dividend paid here. The workings, dividend paid. We paid 640. That's the dividend paid. So it's 640. Then NCI, the dividend paid to NCI. You're here apart from the working, we had already done it. Dividend paid to NCI, it was 10. So unatoa 10. So you get the net financing cash flows, you get 570. You can call it C. Now to get cash and cash equivalent, it's A plus B plus C. So our A was 1250. you add 1450, which is a negative, and then this 57, you add this 570, and you'll get 370. Then we add balance brought down so that we can get the balance carried down. How do we get the cash balance brought down? Now this is how you argue. So tuangalia hapa, this is how we get the cash balance brought down. We are having 2 years here. We have 2012 and we have 2013. Now the 2012 is our balance brought down. 2013 is the balance carried down. Balance brought down, balance carried down. To get cash and cash equivalent, ukuje hapa kwa cash. 2012, there's the balance brought down. The cash hatukuwa na kitu. So that means for our cash, the balance brought down, it's 0 minus ukuje hapa kwa current liability. And the current liability, we have bank overdraft. Still year 2012. Na ilikuwa ngapi? 230. It's a liability, 230. So it's 0, which is cash. We raised 230, which is an overdraft. So that means we started with 230, which is an overdraft, a minus. So if you take 370 minus 230, what will you get? Will you get 140? Now this 140, it should balance with what you have from the trial balance. This is what I mean. Okuje hapa. Now we want to get the cash balance carried down, the balance, cash balance brought down. So tukuje hapa, the cash, you can see we have 140. So itakuwa 140 minus, we are deducting the bank overdraft. The bank overdraft for 2013 is dash. Hakuna, so we minus 0. So in the balance with 140. So if you take A plus B plus C, what you get there, then you minus the cash balance brought down, you should get, it should balance with the cash you're having from your trial balance. So I want you to go and try this question. Assignment. Go and try November 2018. Question 3B. Question 3B. And then the others they're already in your handouts. I already done another one there. So that's the end of group and the cash flows. So cash flow, you need to get the format. So have a lovely night.